Thank you for staying with Benchmark. On the final segment of our show, we focus on monetary policy developments following the devaluation of the Sri Lankan rupee last November. The April issue of LMD contends that the authorities' pro-growth strategy of maintaining a low interest rate environment, loose monetary policy and an overvalued exchange rate have prevailed for far too long. Anushan Selvaraja attempts to find out more.
Welcome to the Voice of Business. Joining me on the show this week is economist with Standard Chartered Bank and LMD columnist Samantha Amarasinghe. Now, Samantha, there's been a number of new monetary policy developments following the devaluation of the Sri Lankan rupee in November and the subsequent removal of the US dollar rupee trading ban. Now, how will these changes affect the macroeconomic outlook, and where on earth is the rupee heading?
Well, yes, we've seen a number of policy changes being implemented over the past couple of months. We've seen policy rate hikes of 50 basis points being implemented in February, central bank intervention through both moral suasion as well as the capping of forex deals to 90 days, as well as reducing the net open positions of lenders to 1/3 of their previous holdings. And it is hoped that these corrective measures will slow down the pace of credit growth, which has been alarmingly high at over 30% levels, and it is also hoped that it will help to stabilize the balance of payments and the current extreme volatility which we are seeing in the exchange rate. On a positive note, the January trade data shows the first signs of a slowdown in credit growth, with imports of consumer goods, including motor vehicles, rising by just 3%. As for your second question on where the rupee is heading, we expect the heightened volatility in the USD LKR spot market to persist, but ease off somewhat once the heavy seasonal import demand ahead of the Sinhala New Year subsides. The spike in Q2 to 135, which we have forecast, is on account of the additional dollar demand returning to the market by the end of the quarter, as the central bank did indicate that it will take oil imports from the market for only a period of 3 months. We have forecast the rupee to stabilize at around 129 by year end.
Now, you say in your column in the April edition of LMD that the authorities' pro-growth strategy of maintaining a low interest rate environment, loose monetary policy and an overvalued exchange rate have prevailed for too long. Now, could you elaborate on this?
Sure. The stress situation that the economy is facing can largely be attributed to misalignment of policies, and in fact the real effective exchange rate was overvalued by around 25%, and the central bank went through a period during which it was aggressively reducing interest rates and in fact eased monetary policy. The repo rate, Sri Lanka's key policy rate, was reduced by about 300 basis points over 2009 and 2010 to boost growth, with the outcome being a rapid expansion of credit and an unsustainable surge in imports. And therefore, inevitably, this led to a drastic deterioration in the country's trade balance.
There seems to be some concern that the corrective measures aimed at curbing credit growth are not enough. Now, why is this so, Samantha? And are we to expect higher interest rates this year?
Yes, to begin with, we have seen market interest rates, treasury bill yields, deposit and lending rates all trending upwards, and they are much higher than policy rates at present. We're concerned that the corrective measures aimed at curbing high credit growth, the 50 basis points rate hike in February and the directive to commercial banks to moderate their credit disbursements may not actually be enough. Also, we expect headline inflation to pick up in the second half of this year once the full impact of fuel price hikes are factored in. So in our view, more needs to be done if such a sharp slowdown in credit growth from over 30% levels to the central bank's end 2012 target of 16% is to take place, as much of this credit growth has in fact been due to imports-related credit. Therefore, we have factored in 2 further policy rate hikes, a cumulative 75 basis points of hikes by the end of this year.
That was Anushan Selvaraja talking to LMD columnist Samantha Amarasinghe. That's our show for today. Do join us again next week. Have a great week ahead.